A new virus emerges, HKU5CoV-2, and its potential impact. The world held its breath as news broke of a new coronavirus, HKU5CoV-2, discovered in China. This ominous development, reminiscent of the early days of the COVID-19 pandemic, sent shockwaves through the global community. Scientists at the Wuhan Institute of Virology, led by the renowned virologist Shi Zhengli, so-called Batwoman, identified the virus. Their research was published in the prestigious journal Cell, detailed the virus's ability to infect human cells. Although the potential is relatively lower than the COVID-19 virus, HKU5CoV-2, like its predecessor SARS-CoV-2, utilizes the ACE2 receptor to gain entry into human cells. This similarity immediately raised concerns about the potential for another global health crisis. The virus was found to belong to the subgenus, a group of viruses known to circulate in bats and pangolins. This discovery highlighted the possibility of cross-species transmission, a chilling reminder of the origins of the COVID-19 pandemic. While HKU5CoV-2 shares characteristics with SARS-CoV-2, scientists urge caution against panic. Early studies suggest that HKU5CoV-2 is less efficient at entering human cells compared to its predecessor. Additionally, the potential for pre-existing immunity from previous coronavirus infections offers a glimmer of hope. The scientific community, still scarred from the battle against COVID-19, remains vigilant. Research continues at a feverish pace to decipher the intricacies of this new threat. Scientists are working tirelessly to understand the virus's transmissibility, pathogenicity, and potential to evade existing immune defenses. The world waits anxiously for answers, hoping that this latest viral foe will prove less formidable than its predecessor. Global markets react. Fear grips investors as stocks and oil plummet. The emergence of HKU5CoV-2 sent a jolt through global financial markets. Investors, scarred by the memories of the 2020 market crash, reacted swiftly and decisively. Stock markets around the world plunged as COVID 2.0 fear and uncertainty gripped traders. The Dow Jones Industrial Average, a bellwether for the US economy, experienced its largest single-day loss of the year, plummeting by 748 points. The tech-heavy Nasdaq Composite and the broader S&P 500 index also suffered significant losses, shedding 2.1% and 1.7% respectively. The energy sector was not spared from the carnage, as oil prices tumbled on fears of reduced demand. The spectre of renewed lockdowns and travel restrictions, a painful reminder of the early days of the pandemic, loomed large over the global economy. Safe haven assets such as gold and government bonds saw a surge in demand as investors sought refuge from the storm. The yield on the 10-year US Treasury note, a key benchmark for borrowing costs, fell to its lowest level in months. The sudden flight to safety underscored the depth of anxiety in the markets. Analysts and economists struggled to assess the potential economic fallout from this latest crisis. The uncertainty surrounding the virus's trajectory, coupled with the already fragile state of the global economy, made predictions difficult. The world watched nervously, hoping for the best but bracing for the worst. Trump's economic policies, a recipe for instability and uncertainty. As if the emergence of a new coronavirus wasn't enough, the falling US consumer confidence and surging inflation expectations added another layer of economic uncertainty to the already volatile situation. Trump, known for his unpredictable and often disruptive policies, wasted no time in throwing a wrench into the gears of the global economy. His aggressive trade policies, reminiscent of his first term, sent shockwaves through international markets. Trump's tariffs, often imposed with little warning or economic justification, targeted key trading partners like China, Mexico, and the European Union. These tariffs, essentially taxes on imported goods, threatened to disrupt global supply chains and drive up prices for consumers. The business community, already grappling with the uncertainties posed by the new virus, expressed alarm at Trump's protectionist policies. Adding fuel to the fire, Trump's hardline immigration policies further exacerbated the economic anxieties. His administration's efforts to restrict legal immigration and deport undocumented immigrants threatened to shrink the labor force and stifle economic growth. The agricultural sector, heavily reliant on immigrant labor, faced potential devastation. Trump's return to power injected a level of unpredictability and chaos into the global economy. His penchant for impulsive decisions and his disdain for expert advice left businesses and investors guessing. The economic landscape, already treacherous due to the looming pandemic threat, became even more perilous under Trump's leadership. The Federal Reserve's dilemma navigating the threat of a hard landing. The Federal Reserve, America's central bank, found itself in a precarious position. Tasked with maintaining price stability and promoting full employment, the Fed faced a daunting set of challenges. The emergence of HK5CoV2 and the return of Trump's unpredictable economic policies threatened to derail the fragile economic recovery. The Fed, having already lowered interest rates to near zero during the COVID-19 pandemic, had limited ammunition to combat a potential recession. The prospect of a hard landing, a sharp economic downturn caused by aggressive efforts to control inflation, loomed large. The minutes from the Federal Open Market Committee's latest meeting revealed the depth of concern among policymakers. Despite pockets of economic resilience, such as a relatively low unemployment rate and modest GDP growth, the Federal Open Market Committee acknowledged the significant downside risks to the economic outlook. Trump's trade wars, coupled with the uncertainty surrounding the new virus, cast a long shadow over the economy. The Fed, caught between a rock and a hard place, faced a difficult choice. Cutting interest rates further could provide a short-term boost to the economy but risked fueling inflation. Keeping rates unchanged, on the other hand, could send the economy into a tailspin. The Fed's delicate balancing act had become even more treacherous in the face of these unprecedented challenges. Market mayhem. The Dow Jones, S&P 500 and Nasdaq take a nosedive. The stock market, a barometer of investor confidence, reflected the growing anxieties about the future. The Dow Jones Industrial Average, a closely watched index of 30 large, publicly owned companies, experienced a series of dizzying drops. The blue chip index, once a symbol of American economic might, had become a casualty of the mounting uncertainties. The S&P 500, a broader index encompassing 500 large companies listed on stock exchanges in the United States, also suffered significant losses. The index, often considered a bellwether for the overall health of the US stock market, plunged into correction territory, signaling a drop of more than 10% from its recent peak. The tech-heavy Nasdaq Composite Index, home to high-flying technology giants, was not immune to the sell-off. The index, which had experienced a meteoric rise in recent years, came crashing down to earth as investors fled to safety. The once unstoppable tech sector, seen as a driver of economic growth and innovation, faced a reckoning as the market reassessed its prospects in a world grappling with a pandemic and political turmoil. The stock market's dramatic decline served as a stark reminder of the interconnectedness of the global economy. What began as a health crisis in China had quickly morphed into a full-blown economic crisis with global implications. Investors, once optimistic about the future, now faced a future clouded by uncertainty and risk. COVID or no COVID, the market is under pressure because of the concern of a looming recession, which may be triggered by Trump's bellicose policies like trade war tantrums, aggressive deportations and tougher immigration and mass firings of federal employees, which may affect US price stability and employment situation. Overall, the market is not ready to take risks after the COVID 1.0 episode. Wall Street, Dalal Street, and also European markets are now extremely overvalued, and thus COVID 2.0 scare may be just an excuse to correct itself. At around $200 TTM EPS for Q3, CY24 and 22 reasonable fair PE against actual EPS KGR of around 7% and potential AI and Trump tax cut optimism. The current fair value of SPX 500 may be around 4,405. The CY24 SPX 500 EPS may come to around $206 at around the current CAGR run rate of 7.00%, and CY25 EPS may be around $226, assuming 10% growth on the higher side. Thus, at around $226 projected EPS for CY25 and 22 fair PE, the current fair valuation of SPX 500 may be around 5,050 rather than current levels of 6,050, even after considering Trump 2.0 and AI optimism. SPX 500 is vulnerable to a deep correction of around 20% to 5,050 levels at any time due to any excuse trigger like the US and synchronized global recession for Trump 2.0, and even any potential COVID 2.0 uncertainty. Trump's bellicose policies, from tariffs, trades, threats, techs, and mass firings of federal government employees, may cause a hard landing for the US economy. Fed is concerned about Trump's policy uncertainty from immigration, deportations, tariffs, fiscal austerity on one side, and tax cut talks on the other side. Thus, Fed may have now no option but to wait for an actual policy move till at least March or even June 25. Thus, considering all the possible scenarios, the Fed may close the QT by Q2 or Q3 CY25. The Fed will do the next QE, if required, in a different composition. And Fed may cut a cumulative 50 BPS in 2025, June and December 25th, every alternate quarter. Thanks for watching. Please watch this space for more insightful AI videos based on my content. If you like these videos, then may also subscribe and share.